Hi, I'm Allie Swafford, President of Prosperity Partners Wealth Management. Today we're going to talk a little bit about ways to stay on track to meet your retirement goals. Are you on track, or are you already retired to retire comfortably? How much income will you need to generate each month? And what might be some of your longer term goals? Maybe not even financially related, but those goals, it would sure help if you had a larger pool of assets or savings to draw from. The statistics aren't good. In a CNBC report, we found that 75% of Americans do not have any professional help for the long haul, and unfortunately, retirement is a long game. It's a marathon. So we need to be prepared, and for most of us, we need some help to make sure that we retire in a comfortable way. So the first thing is set some goals. Too many people just guess. They guess about the amount they're going to need in retirement, and they don't have a written plan. That's kind of the second point, to say that we believe that a holistic financial plan is a must. And sure, regular savings is very important, but you need to have a roadmap that takes you to where your goals are. That's critical. So again, never stop savings. You've heard the old adage, pay yourself first. Well, that's what we still advocate. And another interesting statistic is that according to a survey, 38% of working Americans have too many expenses. For example, on average, Americans shell out more than $2,900 a year on restaurants, prepared drinks, and lottery tickets. Now, we're not advocating a Spartan existence or not to have any fun, but what we are saying is examine your expenditures closely. You might quickly find ways to cut back while still enjoying life's pleasures. And again, pay yourself first. Well, retirement savings is a key component. You know, those of you who are still working, that 401k, this year it tops out for folks under 50 at $19,500, with an additional $6,500 opportunity as a catch-up for those over 50. At a minimum, don't leave any free money, which means your employer match, on the table. Also, know that if you've changed jobs, or let's say you've left a job, make sure that you look, if you've changed jobs, at what are the new benefits. How quickly can you start contributing to your company's retirement plan? For those of you who have left a job, think back. Did you leave any 401ks at other previous employers? It's important that we consolidate. One of the things we find most people want to do, particularly as they get closer to required minimum distribution age, is to consolidate, to make their life simple. So certainly we can look at asset allocation and determine what might be reasonable for you at this point as you look at the potential of your retirement savings through the qualified plans. Get out of debt. That's always a good one. Now, there's some good debt. For example, a mortgage allows you to purchase a home and to build equity instead of renting. But in many cases, debt can be counterproductive. For example, student loans. Yes, they helped you pay for education, and although that is kind of a fluid scenario, the best answer is pay off that student loan debt. Credit card is another debt that often people fall into. These come with often very high interest rates, so we would advise, let's get rid of that debt, that counterproductive debt. And how about Social Security? www.ssa.gov is a wonderful site and has lots of calculators. In addition, we offer, through the American Financial Education Association, classes often, and we're having a couple coming up. One on 8/17 at 10 a.m., another one on Thursday the 19th at 6:30. You can go to our website to learn more about those and to sign up if you're interested. But one of the things you want to make sure is that Social Security has an accurate accounting of all of your wages. Maybe by accident there's a year or two missing in your report, and it is the highest 35 years. This is a great place to start because what we want to look at is what's the core? What is going to come in for you in retirement? Well, let's talk a little bit about the COVID recession and recovery. The economy hit its peak in February of 2020 and bottomed out in April of the very same year. In determining that peak to trough, there were several indicators that came into play. But accordingly, April is when we started to see a recovery. So really, we had a 2-month recession. And when lockdowns and shelter-in-place orders eased May 2020, activity began to rebound. And in some cases, the rebound was sharp. On a historical note, the third shortest recession was tied to the Spanish flu in 1918, and 1957 recession lasted 8 months. So our 2-month recession was the shortest on record. However, the end of a recession doesn't mean that the economy has returned to its prior peak. It simply means that the economy stopped contracting in April and actively turned up last May. While the shortest on record in terms of the decline, the pandemic-related distortions have not yet abated. They may never completely abate. Some industries have performed incredibly well over the last year, while others continue to struggle. During the first quarter and second quarter of 2021, gross domestic product, GDP, which is the broadest measure of goods and services in the economy, expanded at an annual rate of 6.3 and 6.5% respectively. While Q2 missed analyst forecasts of 8.4, it was enough to push GDP above the fourth quarter of 2019, prior peak. Notably, spending Q2 was particularly strong for service-related businesses tied to activities outside the home. I think we were all ready to get out. However, spending in the broad category of services has yet to regain its former peak. Stocks reach new highs. Major averages such as the Dow Jones Industrials, NASDAQ Composite, the S&P 500 all touched new highs last month, building in impressive gains over the last year. For example, S&P, you're familiar with that, 17% year to date. Dow Jones Industrial, 14.1. But we've still got a few laggards, such as Bloomberg Barclays U.S. aggregate bond return, which was negative 0.5%, and the Emerging Markets Index, which was negative 1.0%. So the rebound is robust in terms of economic recovery, but few analysts really predicted that we would see corporate profits soar as high, and in turn, this has fueled a rally in stocks. While rising profits have been big tailwinds for stocks, the Federal Reserve has played its role as well by pushing interest rates to rock bottom levels. In addition, the Fed continues to buy about $120 billion in Treasury bonds and mortgage-backed securities each month, which pumps additional cash into the financial system. As the economy expands and creates new jobs, Fed Chief Jerome Powell suggested last month the Fed is getting closer to announcing a plan to reduce its monthly bond purchases, but he didn't provide specifics on that. Nevertheless, he continues to insist it's too early to start talking about raising interest rates. Ultimately, the path of the economy and the pace of economic growth, coupled with what happens to inflation, will have the biggest influence on when and how quickly interest rates might rise. Well, I hope you found this review to be educational and informative. And let me emphasize that all of us here at Prosperity Partners Wealth Management are open to you giving us a call or sending us an email with your questions. We're honored to have the opportunity to serve you, our clients, and you folks out there that would like to get acquainted with us. Thank you. Make it a great day.